Hello, this is Kyler Worth of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aaii.com/webinars, and AAII members will have access to the full archive of shows. Our guests today are Paul Merriman, Derek Hageman, and John Bykowski. Today's show has 3 topics. First, we discuss how to knock it out of the park with your retirement planning. Next, we run down the first cut list for REITs this month. Finally, we take a look at the newly updated Level 3 portfolio. Let's get started. I'm joined by Paul Merriman, the president of the Merriman Financial Education Foundation and author of We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. Today we are discussing how to financially make the most of your retirement. How are you doing today?
Kyler, I'm doing great. I'm here on the Oregon coast, and this has got to be one of the best places in the world to be right now.
Oh, well, that's great. So happy to have you here today.
Thank you. Great to be here.
All right, let's get right into this. When going into retirement, having too little equity leaves the risk of inflation eroding your savings, and too much equity risks the same during a bear market. How should the individual investor go about choosing the right amount of equity to leave in their portfolio in order to find that perfect Goldilocks sweet spot?
Well, that is both a very complicated study or planning problem. And it's also very simple because we have actually on our website at paulmerriman.com, we have some 160 tables, and most of them are devoted to all the different ways that you can take money out of your investments in retirement, whether you're going to take a fixed amount plus inflation, or you're going to take a variable amount that can go up and down with the market's gyrations. But what they're there to do is to help people figure out what is that balance of, first, how much in equities and how much in fixed income. You hit it right on the nose. If you don't take some equity exposure, and by the way, it doesn't take a lot. Even a 30% equity exposure will do a lot to protect people from the kinds of things that inflation have done historically. Then, of course, at the other end of the spectrum, you mentioned that if you have too much in equity, like, for example, if you had too much in equity in 1970 and then walked right in to the 73, 74 bear market, or how about starting your retirement in 2000 and having your equity exposure be the S&P 500? So there's not just a question of how much in equity and how much in fixed income, but also how much in large companies, how much in small, value, growth, US, international. All those variables move the outcome considerably. So it is a matter of understanding your needs for return. And by the way, even in retirement, when you ask people, is your primary objective to beat the market or get the highest return within your risk tolerance, or find the lowest risk way to meet the need in terms of return that you have to have? Many people, even in retirement, still choose, I want to get the highest return I can within my risk tolerance, which means that person will likely have more equities. The person who says, no, I want to find the lowest risk way to get the return that I need. I'm not trying for a home run anymore. Well, that would suggest, again, looking at strategies that have less equity. And here's the part that is so fascinating to me. Just a 10% difference in equities can make $1 million in difference over a lifetime of retirement, not just a lifetime of accumulating, but I'm talking about just in the retirement years, an extra 10% in equities can make a huge additional, well, it may not be for you, it may be for your heirs, but somebody is likely to benefit from that. So in there someplace for every person is the right combination. And the challenge that AAII and the folks at our foundation, the problem we have is we are not investment advisors. We don't sit down one person at a time and figure out the answers to these questions. Our job is to give a general education and let the do-it-yourselfer figure that out. If you got an advisor, no problem. They're going to dig right in with you and figure out what's wrong, what's right, and what's wrong for you. But when we're educators, it's an entirely different, it's a different way of trying to help people understand investing. We have to go deeper.
In the occasion where an individual investor cannot return to their job and is forced to retire early, what strategy should they implement during their retirement to ensure that their savings last?
Well, this, of course, is the most difficult kind of a situation that we run into if a person is forced to retire and they haven't saved enough before that forced retirement came. So that really is a situation where if you need a professional's help in trying to figure out kind of where you are and what you need, a couple of hours of help from a professional advisor can make a ton of difference, because now there is little room for a mistake. If you have oversaved, which is what we want everybody to do if they can, then you have room to make a mistake, if you want to call it that. And when you just have enough, then it becomes really important how much you're taking out of that portfolio in retirement. Now, oftentimes, people who are forced to retire early are sitting on a whole bunch of equities. And those equities is what got them what they have in terms of their savings for retirement. But at that point, when you don't have a lot of extra money and you need that money to last, by the way, early retirement, forced early retirement suggests more years in retirement, not fewer. You really have to be careful to find that right balance of equity and fixed income. And again, there are lots of resources like ours that show you exactly, at least historically, what has happened with different combinations of stocks and bonds and different levels of distribution. So it just takes some homework and find that balance. By the way, if you can live with a 3% distribution, that is a huge luxury. Unfortunately, people who have to retire early have to push the envelope a little bit, and it turns out they need at least 4%. So that's a negotiation. And again, when you're a do-it-yourselfer, you have yourself to negotiate with. And all we're doing, AAII and the folks at our foundation, we're just trying to help you negotiate with yourself.
Many young investors are willing to take risks with their investments because they know that they have the time to recover if those risks do not pay off. Retirees do not have that same luxury. How much risk should an individual investor take when creating their retirement portfolio?
Well, there's the question of how much risk do you want to take? Are you willing to take? And you got to be careful, because the investment community oftentimes undersells risk and oversell returns. And so you have to find some way to even know the risk that you're taking. Now, I'm not trying to tell everybody that our website has all the answers, but I will tell you one of the things that we provide is what we call fine-tuning tables that allow investors to see not only the return implications, but the risk implications of investing in everything from all bonds to all stocks in 10% increments. And not only is it important to see whether the return would be sufficient, and I always recommend people take 2% off the top just to see if they could make it if things weren't as rosy as they've been the last 51 years, and how they would feel when their portfolio is down 25 or 30% in retirement. Because even a 50-50 stock bond portfolio is destined to go down 25%, let's say 20 to 25% in a really bad year. And I find most retirees are not interested in taking that kind of risk. So make sure that the source of your risk analysis isn't somebody saying, well, you got to be willing to take some short-term risk in order to have the long-term return. No, I want you to see the numbers. It's what I call the fright simulator, but I think we all need that fright simulator for the truth.
Are there any methods retirees can use to circumnavigate the issue of inflation, even if they do not have more than enough in their portfolio when retiring?
Well, boy, this is a tough one, because when we talk about inflation, we don't know if we're talking about a little bit of inflation or a lot of inflation. I find, again, I'll go back to what I said earlier, you've got to have some exposure to equities to fight inflation, at least from what we know historically. And so, my hope is that when we talk about inflation, that the people who are facing retirement have, let's say, their house paid for, so that they don't have to face the impact of having to buy a house that's going up and up and up. They have a house, they have that locked in. And so at that point, and of course, housing is a big deal, and healthcare is a big deal. But if you've waited until you qualify for government help and whatnot, then that is going to give you some protection. But to the extent that you run into some inflation, you've got to be realistic about it and think in terms of what today's costs are, build your budgets on what today's expenses are, and maybe you have to do some cutting. You have to find a way to make up for inflation by adjusting what your expectation is for returns and what distributions you're going to take. And it turns out there are lots of books. In fact, there are lists of ways for people to save money. All you have to do is do a search for 100 ways to save money, and you'll have all sorts of lists that you can read. Well, you got to get serious about some of those and start tightening the belt. Maybe you got to go to work part-time in order to fight inflation. You really want to do all you can to protect that principle that you have that has got to be there for the rest of your life to spit out the distributions you need, even with your lower cost of living, cost adjusted distributions that you're going to be taking because of inflation.
Well, thank you so much for joining us today.
Been a pleasure. Thank you very much, Connor.
If you are interested in reading his article, How to Score a Retirement Home Run, or others like it, you can find them in the September journal at AAII.com. Once again, thank you and have a great day.
Thank you.
Hello, today I'm joined by Derek Hageman to discuss the first cut list for REITs. Derek, how are you doing today?
I'm doing well, Kyler. Thanks. How are you doing?
Great. Excited to have you here and excited to get right into this. Let's get
Excellent.
started.
Let's do it.
If some of the strengths of investing in REITs are its liquidity, limited liability, protections, and less hands-on work, what are some of the weaknesses that individual investors should be aware of when looking at these companies?
Yeah, that's a great question. And before I answer that question, I just want to give a little background on REITs. So REITs are a popular way for investors to own income generating real estate without having to purchase or manage property. So a lot of advantages there. There aren't any tenants or backed up toilets to deal with. So there are two main ways to invest in real estate. One is private real estate investment. So as a private real estate investor, you may physically purchase buildings to lease or fix up and resell yourself, or you may lend money to a purchaser. The second option is public real estate investment, which takes the form of REITs. So many investors like REITs for the income distributions. Unlike traditional corporations, REITs must invest in real estate and distribute 90% of their taxable income in the form of dividends. So that's nice as a dividend investor, but this does leave little money for growing the portfolio by buying more properties. And those are the activities that drive appreciation. Another one of the weaknesses of REIT investing is these distributions are not qualified dividends. Rather, they're taxable at each individual investor's marginal tax rate when received in a taxable account. So depending on the type of accounts you have and your tax situation, this may or may not be an important consideration when looking at REITs. REIT dividends, like I said, they come with unique tax consequences for investors. These payments can constitute ordinary income, capital gains, or a return of capital, each with its own tax treatment. And lastly, just one last point on REIT investors, they should be aware of, like other investments, investors need to do their due diligence before investing and consider the different factors in the real estate market, such as property values, interest rates, debt, geography, and changing tax laws.
In the article, you mentioned how these REITs were chosen based off of a growth-oriented strategy. Does this mean that investors looking at these companies should view them as long-term investments?
Yeah, Kyler, I think that's a fair way to look at them. And like you said, we chose to focus on a growth-oriented strategy, and specifically we required stocks to have realized annual revenue growth greater than 3% over the past 5 years. This narrowed the result of REITs that have been able to increase annual rent rates or occupancy levels, which are obviously very important for REITs. We then required high quality dividend paying companies that have continuously grown their dividends for at least 3 consecutive years, and a minimum dividend growth rate over the past 5 years of 5% was also chosen to ensure that the REITs have grown in excess of the rate of inflation. So we think these are a few of the characteristics that investors should seek to identify when they're looking for quality long-term investment candidates.
On the list of 10 REITs, Arbor Realty Trust Inc. is listed as having a dividend yield of 7.5%, which is nearly twice the amount of company with the second highest yield. Is there a reason for why this company's dividend yield is so much higher than the rest?
Yeah, I mean, that's a good observation, Kyler. And compared to the other REITs on the list, the yield for Arbor Realty Trust, it definitely jumps out. It's just important to recall that yield is the projected dividend payments per share for the next 12 months divided by the current stock's price. So there really are 2 reasons why the yield can increase. And again, all other things being equal, if the indicated annual dividend increases and share price stays unchanged, then the yield increases. Also, if the annual indicated dividend stays the same and the share price drops, then the yield rises. So for Arbor Realty Trust, over the last year, I mean, the company has raised its dividend 4 different times. That's incredible. Its dividend has grown by nearly 13% over that period, and its stock has increased by over 50%. So the stock price has increased faster than the dividend growth. And that's one of the reasons for the high yield. But really, over the last year, Arbor Realty Trust yield, it's actually decreased from over 10% to over 7% now. So no doubt that Arbor ran into some challenges during the early days of the pandemic. But since then, it has done a nice job of growing its loan portfolio and improving its book value per share.
Thank you so much for joining us today, Derek.
Definitely, you're welcome. It was a pleasure being here.
If you're interested in reading his article, First Cut List, Real Estate Investing Without Purchasing or Managing Property, or others like it, you can find them in the September Journal at AAII.com. Thanks again, Derek, and have a great day. Today, I am joined by John Bykowski, President and CEO of AAII, to discuss how the Level 3 Passive Portfolio is doing up to this year. How are you doing today, John?
Doing great. Yourself?
That's great to hear. All right, let's get started. In 2020, the Level 3 Passive Portfolio had a significantly weaker performance than it did in 2019. Already this year, the Level 3 Passive Portfolio is outperforming how it did the previous year. Should there be any concern for how the portfolio performed in 2020 moving forward, or was that all due to the pandemic?
It was largely due to the pandemic. I think 2020 was a very narrow market. The securities that did very well in 2020 were really the industries that benefited from the stay-at-home home improvement area, and was really focused on large cap growth segments. As things opened up this year, in effect, all the stocks that did poorly last year, all the sectors that did poorly last year, were very strong in 2021. Real estate, which was negative last year, REITs is one of the stronger segments this year. And that kind of, I guess, points to the notion of having a long-term perspective in mind. And that really is sort of the key factor here, is understand that this is meant to be kind of a hold type set of a portfolio, one that you take a look at long term. And it's sort of designed, when Jim Cloonan put this passive Level 3 portfolio together, he was trying to, in effect, come up with allocation of investment types that are different perhaps than the market, and have characteristics that might help them perform better than the market long term. But there has to be understanding is that you probably will have periods of underperformance, and that's the type of situation that occurs when you try to be a little bit different in the marketplace, is that you'll have times where you look better and times you look worse.
The 4 ETFs in the portfolio, are there any that could be replaced in the following year, or has the recent performance of the portfolio secured a place for each ETF?
Yeah, that's a great question. And I think in general, what we're finding is there is some overlap. I think that the genesis of the portfolio was to, okay, if you're going to invest, say, in the S&P 500, are there alternatives that might do better long-term based upon past performance? So as one example, looking at how an equally weighted part of the S&P 500 versus the market cap weighted 500, how that would perform long-term. Now, long-term, it's done better. It tends to push your portfolio down to a little bit more smaller companies than just the S&P 500, which is concentrated in just a few firms. And what we're looking at doing is, when Jim first put together these 4 ETFs, he was trying to kind of mirror that type of potential segment. So we're always on the lookout to see how can we take the different segments that do have some characteristic of positive attribution to your portfolio, positive in the sense of increasing diversification, positive in the sense of having some long-term record of being able to match or perhaps even exceed the market based upon their risk profile. And how can we keep adding to that and improving upon it? So yeah, we do see, I think, the potential to change some items. There's some overlap between some of the segments that are in there, and there is no small cap segment in there, and there's no international. So we're looking to see whether or not it makes sense to add some of those segments to the ETF portfolio to give it more balance and diversification.
This portfolio is considered passive and makes up of incredibly large companies like Apple, Microsoft, and Amazon. What are the advantages that come with designing a hands-off portfolio like this, and what are the disadvantages?
Sure. Well, the key here, and like you said, some of the holdings in here are, even though it's passive and equally weighted, no matter what, some of the largest companies that are in the U.S. are going to be represented by the ETFs that hold them. But the key here is that I think you have to sort of take a self-assessment as to how much time and effort you want to put into managing your portfolio. There's understanding that if you have a long horizon, if you're looking, for someone young like yourself, and you're looking at trying to build wealth in the long term, it makes a lot of sense to put money into the stock market. And if so, you could either choose to be very active in how you pick your portfolio. You want to have a diversified portfolio, or you could go ahead and simply try to put together a portfolio of ETFs or mutual funds that'll help give you that market exposure. And the consideration there is you want to have something that's very low cost and efficient, because if you're doing your own research, why pay for any kind of those long-term drags? So the notion of having a passive portfolio like this was okay. I don't want to spend a lot of time day to day managing my portfolio. Perhaps take a look at my allocation once a year, or if it's a change in my life stage, and then go ahead and make an adjustment. So this is designed for someone who wants equity exposure and wants some of that long-term benefit that equities provide. It doesn't want to take the time and effort of managing and putting together a individual stock portfolio. So it's for the person that wants to participate in the market, but wants more of a hands-off approach.
Vanguard Real Estate makes up only 10% of the total weight of the portfolio, while the other three ETFs make up 30% each. Is this difference due to the market Vanguard Real Estate works in, or specifically because of the ETF itself?
Yeah, it was an attempt to add a little bit of a different diversification to the portfolio. Normally, you don't want to do less than 10% because that's sort of the threshold of having impact on the portfolio. So there was some evidence that long-term real estate provides rates of return that are similar or equal to that of the stock market, large cap stock market, but provides a diversification element. Now, diversification has two swords to it, right? So last year, as an example, the real estate market REITs were down more than the market, and it had negative rates of return. This year, it's doing very well. That's sort of the downside of diversification, is that you might have certain periods of time where certain segments are underperforming, but long-term, you should be able to either keep your rate of return equal and reduce your year-to-year volatility, or hopefully at least keep perhaps boost your rate of return and still have some of that benefit of diversification. When it comes to the financial markets, there's a saying that there's no free lunch in the markets. Well, actually, sometimes people say diversification is the one free lunch that the market is providing you, because there is the benefit of the ability to maintain your expected rate of return, yet reduce your volatility. And when you reduce your volatility, it helps preserve you from taking actions that might hurt you long term.
In the article, you mentioned that rebalancing the Level 3 passive portfolio should be kept to a minimum. Is it worth waiting a year before even considering rebalancing so that the companies in your portfolio have a chance to recover from COVID?
Yeah, and again, I think the notion of a rebalancing is important, and I guess it's always important to come up with thresholds in advance. So if it's a once a year review, you can go ahead and see if there's certain sectors that have done worse than others, and you could go ahead and make those adjustments. So in effect, the notion of rebalancing is that you want to put more money into the items that are undervalued potentially because they've gone down in price, and perhaps sell off some of your winners that have really done well and are now making too much a portion of your portfolio. So you could either once a year was a good framework. You could also do it if there's a major change in your lifestyle. All of a sudden you need to make a decision because you decided you're going to either retire or change careers or do something or have a kid, and all of a sudden you need to make sure you're balanced correctly for your needs. Or it could be that there's a major market event and you might now have an opportunity. You don't want to act irrationally, but perhaps there's a chance to go ahead and pick up some assets at a lower price. So I think the notion of rebalancing is that it's important to, first of all, segment how you want your allocation and what your thresholds for rebalancing are and your timing. because you don't want to make judgments at the wrong time. And I think that's you can look back to how you acted last year. How uncomfortable were you as an investor when the market really went down sharply last March? How did you act? Were you really concerned about your portfolio going down that much? Were you at that point in time, were you considering getting out of the market? Because that's the whole notion, is that you don't want to go and do irrational decisions at the wrong time and hurt yourself long term. The whole notion is, our goal as investors is to, in effect, buy low and sell high. And the asset allocation rebalancing kind of helps do that in a very structured way.
Well, thank you so much for joining us today, John.
It's been a pleasure. Thanks for the interview.
Of course. If you were interested in reading his article, Level 3 Passive Portfolio Up Strongly Year to Date, or others like it, you can find them in the September journal at AAII.com. Once again, thank you, John, and have a great day. Hi all. If you weren't aware, we record this show in advance of the broadcast date, and we do like to answer questions in our listener mailbag segment. We didn't receive any questions for this episode of the show in advance, and so I just wanted to remind our viewers and listeners that you can do so. If you have questions for us for a future episode, or on anything you have seen or read from AAII content, please send an email to kworth@aai.com with the subject line II Show Question. We'll try to get it on air for the next episode.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look.
If you liked our show, please visit aai.com/webinars to register for more webinar and video content. Like us on Facebook and follow us on Twitter at AAII_invest_ed. For more investing education, check out our site, AAII.com. I want to thank our guests, Paul Merriman, Derek Hageman, and John Bykowski, and you for listening. See you next time.